studying your last two. I swim with tea when they turned in. The staring down to mute and can lend a pole that sunk he died.
When preparing a corporate tax return, it's important to distinguish between ordinary business interest and interest or penalties charged by the Canada Revenue Agency. Although both may appear as expenses in the accounting records, they are treated very differently for tax purposes. Let's start with the accounting treatment. If a corporation receives a CRA notice charging late payment interest or penalties on income taxes, those amounts are recorded as expenses in the accounting records. For example, suppose the corporation pays $700 of interest and $300 of penalties. The full $1,000 is recorded as an expense and reduces the company's accounting income. However, the tax treatment is different. The Income Tax Act generally does not allow a deduction for interest or penalties that relate to income taxes, since these costs arise because of tax obligations rather than from earning business income. They are not considered deductible business expenses. As a result, none of the $1,000 can be claimed as a tax deduction. Instead, the entire amount must be added back on Schedule 1 when calculating the corporation's taxable income. Notice how this adjustment works. The accounting records reduce income by $1,000, but the tax rules reverse that reduction by adding the full amount back. This increases the corporation's taxable income by $1,000. A simple way to remember this rule is to separate accounting from tax. The accounting records recognize the expense because the corporation actually incurred the cost. The tax rules, however, deny the deduction because the expense relates to income taxes rather than earning business income. So whenever you see interest charges or penalties from the CRA that relate to income taxes, your first thought should be recorded in the books, but not deductible for tax purposes. That means the full amount is generally added back on Schedule 1 as another common T2 adjustment. One of the most common mistakes made by new tax preparers is confusing deductible business interest with non-deductible interest charged by the Canada Revenue Agency. Although both are called interest, they have very different tax treatments. Let's start with business interest. When a corporation borrows money to earn business income, the interest on that borrowing is generally deductible. Examples include interest on business loans, commercial mortgages, equipment financing, and business lines of credit. Because these funds are used to operate or grow the business, the related interest is normally allowed as a tax deduction. Now compare that with interest charged by the CRA. If the corporation pays its income taxes late, the CRA may charge interest on the outstanding balance. The CRA may also assess penalties for late filing or failing to meet certain tax obligations. These charges are not incurred to earn business income. Instead, they arise because the corporation did not meet its tax obligations on time. As a result, interest and penalties related to income taxes are generally not deductible for income tax purposes. This distinction leads to two very different tax treatments. Business loan interest is generally deductible and usually requires no Schedule 1 adjustment. CRA interest and penalties related to income taxes are generally not deductible, so the full amount must be added back on Schedule 1. Whenever you're reviewing an interest expense, ask yourself one simple question. Why was this interest charged? If it was charged because the corporation borrowed money to earn business income, it is generally deductible. If it was charged by the CRA because of late payment of income taxes or tax penalties, it is generally not deductible and should be added back. Keeping this simple distinction in mind will help you avoid one of the most common classification errors in corporate tax preparation and ensure that Schedule 1 reflects the correct taxable income. When reviewing a corporation's expense accounts, One of your responsibilities as a tax preparer is determining whether each interest expense is deductible or whether it requires a Schedule 1 adjustment. A good place to start is the general ledger. Look for accounts with names such as interest expense, CRA interest, tax interest, penalties, or late payment charges. These accounts deserve special attention because not all interest is treated the same for tax purposes. As you review each expense, ask yourself a few simple questions. First, who charged the interest? Was it a bank or another lender? Or was it the Canada Revenue Agency? Next, ask why the interest was charged. Was the corporation borrowing money to operate or grow the business? Or was the interest charged because of unpaid income taxes or a late tax filing? If the interest relates to a business loan used to earn business income, it is generally deductible. In most cases, no Schedule 1 adjustment is required because the accounting treatment and the tax treatment are the same. However, if the interest or penalty was charged by the CRA in connection with income taxes, the answer is different. These amounts are generally not deductible and must be added back 100% on Schedule 1. As you review client files, pay particular attention to common warning signs: CRA interest charges, late filing penalties, interest on unpaid income tax balances, reassessment interest, and tax arrears interest should all prompt you to consider whether a full add-back is required. A useful habit is to never assume that every account called interest expense is automatically deductible. Always investigate the source of the charge before deciding on its tax treatment. The rule is actually quite easy to remember. If the interest was incurred to earn business income, it is generally deductible. If the interest or penalty relates to income taxes charged by the CRA, it is generally not deductible and should be added back on Schedule 1. Following this review process will help you classify interest expenses correctly, avoid common errors, and ensure that the corporation's taxable income is calculated accurately.